Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. What I'm doing here is a follow-up video to a video I published on March 9th, 2018 on the company Albemarle. And here's what I had to say at that time about this company, just a short excerpt.
And what you have here is a very exciting forecast for future growth. 2017 was a very good year with high growth averaging almost 29%. And we're forecast to see double-digit growth rates for the next couple of years. And you see this nice trend line. And now we see the price moving back there. The question is, has it gotten there yet? Now, I don't particularly think this company has become attractive yet, but I certainly believe it's more attractive than it was in September of last year. But the key is, if you just run the numbers here logically, if you bought it today at 21 PE, and it did go down to either at 16 or 15 PE, and I'll use the more positive one, this would mean about a 3% rate of return, including dividends, over the next couple of years. Not a loss, but obviously not a real attractive rate of return for a company that is proven to be cyclical over time, has a pretty good dividend record, a pretty good dividend growth record. I think it's important.
So just to summarize, I felt the stock had had a big correction, but was still overvalued even though the earnings growth had grown dramatically. I want you to notice the earnings estimate for 2018 was $5.15 and $5.85 at the time for 2019. Now let's take a look at the current fast graph and see how it's changed. This is what Albemarle looks like. And what this really is, ladies and gentlemen, is an exercise in valuation, or a lesson in valuation. I can only do month-end closes here. So this is February 28th, 100. It's about $2 more than it was when I first wrote the article in 2018. But you can see that the price has continued to fall. Now it's actually, through yesterday's close, fallen about another 29%, which is logical, but now it went from being moderately overvalued to now I consider to be very attractively undervalued. I want you to notice a couple other things. Instead of $5.15, the company actually came in with earnings of $5.48 in 2018. Additionally, the estimate for 2019 when I wrote the article was for $5.85. That estimate's now risen to $6.20. So instead of getting a 12% growth rate in 2018, we got a 19% growth rate. But even though the company has exceeded forecasts, the stock price has now reverted back to the mean and then overshot it. It's now gone into negative territory. Now, a lot of this has to do with a lot of negative press on companies like Tesla. You know, this is all about lithium production and the electric car movement and the greening of America, etc. But now, if we look at forecasting on this company today, we're expecting earnings growth of about 10.5% over the next couple of years. There are a lot of analysts following this company. It drops down to 12 analysts in 2021 and then only 2 analysts. So I really don't like to go much further than here. So if we traded at a 15 PE, which has been long-term historical normal for this company, the normal PE I've quoted at 17, but if you look at the historical graph, you can see a 15 to 16 or 17 PE has been quite normal for this company. But again, if we go to that just normal 15 PE, we got a chance to make an annualized rate of return of over 27% a year. Now what's really interesting, if you look at the long-term growth rate forecast, analysts expect this company to grow at just under 14%, 13.67% a year. So long term, this could be a double-digit, almost 20% annualized rates of return, or approaching that, over the next 3 to 5 years. Now this is a good company. It's BBB rated, has 25% debt. It currently offers a 2.1% dividend yield, which is historically high for this company, simply based on the fact that typically its valuation was high. Like if you look back at its peak valuation here, back in November of 2017, the company was only yielding 1%. So because the valuation has fallen so much, the starting yield is 2.1%. The company's historical performance long-term has been excellent. It has outperformed the S&P by orders of magnitude on dividend income, and it's dramatically outperformed it in growth. And the total annualized rate of return, dividends plus growth, has been almost triple what the S&P was. It turned 10,000 into 86,000 instead of 10,000 turning into just under 25,000 in the S&P. Now the company has been cyclical historically, but what we're really looking at here is a new era for this company. We're moving into into lithium, and lithium is what this company is all about. Now, if you look at what the company's doing currently in terms of price, it's up about 1.5 points. We have a good day today. It's getting some decent press again. Albemarle did outline a plan to lift Chilean lithium output by 30%. They announced that on June 12th, just about a week ago. That's kind of positive news, meaning that they're increasing their production of lithium. And they're not going to participate in the London Metals Exchange lithium contract, which is really all about turning lithium into a commodity. They call it a specialty chemical rather than a commodity. Of course, lithium is going to be used in lithium battery production for electric cars and all the other uses of lithium. So anyway, this is a very interesting company that is now currently trading at a blended PE of 12, offers a 2.1% dividend yield, and really excellent growth potential. It's widely followed. There are a large group of analysts that are following this company, so we have a real solid consensus here. I think this is something you might want to take a closer look at if you're looking for total return over the next 2 or 3 years. Anyway, this has been Chuck Carnevale saying thanks for watching. If you like this video, don't forget to hit our subscribe button at the bottom here. Thanks again for watching.